Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is what date? The middle of September. We're nearly coming to the end of Q4, Q3 with Q4 on the horizon. We've Brent crude oil trading up again this morning at 67.42, up about a little over 0.5%. The sort of bounce around 65 to 67 and change seems to be a continuous move here without anything specific. Let's kick off, as always, Monday morning with Omar Najia, the derivatives trader at BB Energy. Omar, your thoughts on direction of this is a market that seems to be looking for direction. Will the Fed rate cuts this week, long expected, be that direction?
Well, what's interesting is that most people like to look at like supply and demand, right? So they're always telling me OPEC's increasing, there's demand is I don't know what. The EIA said last week that they expect Brent crude price will decline significantly, falling to $50 by early 2026. That's like $17 a barrel lower from here. So we kind of take the opposite view. We think basically crude prices are going to go up. We think crude prices are not based on supply and demand and how you count them and all this kind of stuff. I think it's, all kind of whatever, and all kind of methodology. It's macro stuff. Macro is very clear. They're going to cut rates. Everything's going to go up. Equities are going to go up. Gold is going to go up. Uh, Currencies are going to move. Everything's going to move. So if you believe in supply and demand, then basically you come and say, yeah, no, 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 everything's going to move except oil because that follows supply and demand. So no, we think basically oil is going to move as well. Betting markets say that they're going to cut three times in 2025. So that's at least 0.75% cut, maybe up to 1%. So that to us is bullish. And then how you can say you expect oil prices to fall in Q4 and not look at all anything to do with geopolitics and you coming war to the Middle East between Israel and Iran, which seems highly likely after the Israeli strikes on Qatar, destroyed the kind of, security environment of the GCC, all that kind of stuff. And you come up with these statements. So I think we're looking for the market to go higher. Don't forget, it's not that the market is lacking direction. It's that since WTI fell to about 55, everybody and their friends have been calling for the death of the market. Yet we don't go down. And then basically you had OPEC saying we're going to increase, we're going to do 2, 3 weeks ago when they were going to do their last increase again on the show, same thing. It's gonna die, everything's terrible, and I don't know what, and supply, and what happens? We go up. So I think basically we're going to keep going higher. So I'd look for Brent at 80, 85 before the end of the year as opposed to 50. So somebody's going to be extremely wrong, or wrong and long the market. So we'll see.
Brian Pieri, founder of Energy Rogue, out there in wonderful Colorado. Brian, it does seem that there's logic, and then there's just the world we're in, which is everything is upside down. And but your thoughts on the because the argument that Omar's making, obviously rarely rational, but always quite often true, but is the fact that there has been a lot of bullish elements in this market for the financial markets. Equities have been going up, and all the gold has doubled in the last 2 or 3 years, and all of the Bitcoins on a steroids, and oil hasn't joined the party. Why would it join the party now? That's my challenge with Omar's sense of things that all of these factors have been in place, and yet oil hasn't really joined the party. Your thoughts on will oil join the party now?
You know what? That's a great question. And thank you, Sean. Thanks for having me this morning. Omar makes some fantastic points, and I completely agree that oil is positioned to increase. I'm slightly differing on timing and execution. I think we're going to dip down before we head back up. So I don't know if we'll have the same timeline that Omar's laying out, but one thing I noticed this morning on WTI commitment of traders, a lot of the hedge funds have transitioned over the last month and a half from long to flat. So this is the shortest because they've held a long position for a long time. This is the shortest I've seen in quite some time, and that makes me a little antsy and expecting possibly a correction down into the 50s for WTI, and then we head back up because one thing is clear that supply will not be growing at this level. Supply and demand is tighter than people expected in 2025. Now, to your point, Sean, I think there's a lot of interesting things because if we go back a decade or even 15 or 20 years, crude prices are flat. When you look at the inflationary value of everything else, crude should be probably $300 or $350. So it didn't make logical sense when you pin it to inflation or you pin it against other things. So your point is right on target that everything else is inflating. Crude hasn't, and I think that that is because of monetary flows, not so much because of fundamentals, and not so much because of the absolute value of the crude oil. Because one thing is very clear, last year we did not grow very much crude supply, and our price level was $10 to $15 higher. So the supply side is going to be more challenged now than ever. And I say supply side because this is applicable to national oil companies, independently owned and equity owned institutions. They're going to have a hard time keeping up. Demand is probably the bigger question. As a matter of fact, one of the articles that you guys added in the daily top 10 was about the China involution. And I think that's a great article. And I think it's a great topic because Chinese population is shifting. And then you look at the involution, but you also have to look at the energy demand per person. In other words, the demographics of China, it is getting older, but there's a higher energy consumption per person than there was 10 years ago. So what does that mean for the energy future? And I think that's probably the crystal ball question.
Let's welcome Yan Chong Yaw, Director Research at Wood Mackenzie out there in Singapore, where I just came back from a week at APEC. And Yan, the big conversation there, or the question, if you like, as to the support in this oil market has got over the first 3 quarters from China buying more than maybe had been expected, but putting over 500,000 barrels a day into inventories. That's been a very supportive buy on the market. Your thoughts of that sustaining through the fourth quarter? Do you buy Omar's argument that now oil will join this financial assets bubble march into records, gold every day, equities hitting records every day, that now it's oil will join that?
No, I don't think. I mean, 80, 85, 90 is going to be a little bit optimistic. While yes, Chinese demand has returned, has gone up, it's higher year on year. We are averaging about sort of 11.25 million barrels a day this year, right? Up till
On imports.
August. Yep, on imports, right? And refinery runs are year on year higher at about sort of 77, 78%. Yeah. However, sorry, you guys there? Sean, you're a little frozen. Okay.
Yeah.
Good. Okay.
Believe me,
So,
I'll interrupt you.
yeah, sorry. No. Yeah, so but it's higher year on year, but actually not even higher than 2023, right? And I mean, I believe that the Chinese economy is better year on year, but it's nowhere near pre-COVID type of economy, right? I mean, if you go to China, people are still not spending, the property market has not come back, you still see projects that are frozen in time, not moving, and ultimately diesel demand in China is not there as well. They're producing less than they have. They were producing actually too much from 2022 through to H1 2024, the producers or the refiners are basically saying, look, I can't produce as much as you want me to produce anymore because they are very, very long, right? So yes, it is stronger year on year, and it will get stronger as we go towards 2026, but it is not the magic bullet. It is not going to be pre-COVID levels. I think we are
But
some distance from there.
this buying for inventories is sort of agnostic to economic health, right? Energy security is a big new demand data point.
Yes, they have, but China has always been concerned about energy security, right? Pre-COVID, post-COVID, they have always been. And well, I mean, especially in the last couple of years with uncertain political geopolitics, but especially between China and the US, they have always been, well, concerned about energy security and make sure that they have enough, right? I mean, that was the reason why I believe that they produced that much diesel from 2022 through to first half 2024, because they were producing a lot and exporting very little. So, for example, one of the things that we do look at is how much they produce versus how much they export, right? And that ratio between export and output for diesel had been falling since 2022 to 2022 was about 6%, 2023 was about 5%, 2024 was slightly higher, 5.5 this year, up to now is 3%.
So
Right, so
3% of the diesel produced, refined in Singapore or in China is exported.
yes, only 3%, right? But obviously the production levels drop because in 2022, 2023, it was getting higher every year. It hit record in 23 at about 18 million tons a month,
So
right?
the
Now
lower
we're
percentage is a reflection on less diesel being refined rather
exported,
than
yeah,
being
exported,
exported, but also
yeah.
being refined.
No, more being refined because they produce record high volume of diesel in
Well, that would be
2023.
quite bullish, wouldn't it? Because it would indicate the Chinese are burning more
Strategic, my
diesel.
friend, strategic.
Strategic.
They're not using, right? Because the
Ah.
Chinese economy isn't great, right? And you're exporting so little. What are you doing with it? The rest, right? They have to be stockpiling, right?
Stockpiling.
And there's
Stockpiling.
also this element of increased military use, right? They're conducting a lot more
Right.
exercises. They're doing a lot more drills. How much
Yeah.
the military actually uses, nobody knows
Right.
exactly.
They have a big
But
navy now. That navy's
yep,
growing all the time.
exactly.
Consumes
Yep,
a
and the
lot of
Navy is
diesel.
doing more incursions in and around the disputed areas, Taiwan, Spratlys with the Philippines, among other things, right?
Oh, let's get back to Omar and get some further meat on here. The bullish nature of of your call on the market, Omar, obviously oil to join the party is the fact that the party would continue, but inevitably lower interest rates in the US reflective of the idea that the economy is weakening. There's more unemployment. The jobs that are being created are less. So where does that fit into the thinking vis-a-vis? Yes, you could say rates are going down in order so that the US can maintain the ability to pay its debt or its interest on its debt, but it's also coming with a weaker economy. How do those two things go together?
I mean, you have to understand what fiscal dominance is. They're not cutting interest rates because the economy is good or bad or unemployment or anything like that. They don't care what any of that stuff is. They don't care what inflation is. They don't care what unemployment is. They're cutting interest rates because they can't afford to keep paying the debt interest rate that they are paying. That's the only reason. That's called basic. So it's no like that's why the Fed won't be independent anymore. The Fed isn't doing what's good for the economy. The Fed is now the Treasury. The Fed basically does what Treasury wants, and Treasury, what does it do? It issues debt. So you need to lower interest rates to sustain and keep issuing that debt. That's the only reason they're lowering interest rates. And even if inflation, and how do we know? Because inflation, CPI came out last week, right? It was 3.1% year on year in the States. With 3.1% inflation, what are they going to do? cut 3 times in 2025, and they will cut more in 2026. The US economy it's got nothing to do with basically where the interest rate is set, because it's way too late for that. The interest rate is basically set because they need to borrow more money and they need to keep issuing new debt, and they can't afford to pay the interest rates that they do now, which is also why they're issuing all the debt at the front end of the curve, right? So they're hoping that something happens to save them from this kind of stuff. But if you've got 120% GDP, 37 trillion in debt, 6-7% budget deficit a year, you're stuffed. I mean, you're absolutely stuffed. And it's the same with all of Europe. It's the same with all this kind of stuff. The only solution in town is what we've had since 2008, which is basically print more dollars, debase the currency, inflate your debt away, and hope by a miracle that you get something to do with productivity, which they call AI, because this is the kind of thing that's going to come and save the entire, US economy, because it's going to bring productivity like crazy, et cetera, et cetera. So this is basically what you're looking at is fiscal dominance. What you're looking at is the Fed losing control of long-term interest rates because nobody wants to buy American debt. It's that simple. So that's one side of the kind of equation. The other thing that I want to say is if you look at markets, you have a term called divergence, right? Which is basically if something is going one way and another thing is going the other way, there's a divergence. Divergence, basically, you don't want to basically build on it. You want to bet the other way. So when you have oil prices going down and everything going up, what you want to do is buy the thing that's going down and sell the thing that's going up, not keep buying the thing that's going up and sell the thing that's going down. There's divergence. So the signal that divergence is giving you is that it's going to come the other way. So that's the reason why oil is basically going to go up. You can
Brian,
manipulate. Yeah,
let's go to Colorado. Come in, Colorado. Are you feeling fiscally dominant, Brian, or are you feeling fiscally dominated? And in that sense, will this cheaper money, will this sort of liquidity and more quantitative easing, if one wants to see it that way, bring life to the Permian Basin? Will it bring U.S. oil companies back? They seem to be laying people off rather than hiring. The health of new supply coming out of the U.S. At these prices.
Yeah, so piggybacking on what Omar is saying, there is a weakness in the economy. There is a weakness in the underlying financial structure in the United States with the United States dollar, and how that interlinks with crude oil is very fascinating, especially since COVID. Prior to COVID, it was pretty much assumed that you had the petrodollar. And if the dollar got stronger, crude got weaker, and the inverse would be true. And nowadays, that relationship is more muddy than ever. And what I would say is, piggybacking on what Omar is saying, when you're looking at the asset classes and you see that divergence, that's why crude is vastly undervalued right now relative to the entire field. Because we used to look at one relationship, which was crude oil to the US dollar. Now we have to look at crude oil, US dollar to Bitcoin, to stock markets, to equities, to this. Like it's a myriad of a bunch of different interrelationships.
Are we seeing that attraction to? I mean, are the funds, the mutual funds, where they sort of manage all of everybody's pensions, and are we seeing the funds say, "Oh my gosh, look at that divergence Omar is talking about. Let's put some of it into oil because it's cheap"?
Yes and no. There's still a stigma around oil for U.S. mutual fund companies because of a long-term legacy souring on the energy field as far as there was a systemic effort to focus on green energy and not the fossil fuel energy, and that legacy has not quite been shed. However, there is a reckoning coming, and the reckoning is coming in places that are going to be driven by fundamentals. For example, California just shut down this year 2 refineries. And what that means is when you look at the prices at the pump, you have $6 gasoline, whereas in Oklahoma and Texas, it is $2.50 to $3. And when you're reducing the capacity to make more diesel, make more gasoline, when you're reducing that capacity, they're going to have to import from somewhere. And something that I heard this past week that I'm going to have to fact check because I was like, wait, what? Somebody said that there was an exploration for California importing gasoline and diesel from Japan. And I said, wait, that Japan doesn't produce those. Like, are they just taking a ship and spinning it? I don't understand that. It's curious to me. So there's very curious things, but that is a reckoning of the fundamental fact that there has to be some reckoning with supply and demand balances. And the more recent signals on supply and demand is that the economy, and when we look at distillate stocks over the past week, we increased by 5 million barrels. That tells you the underlying industrial commercial economy is struggling a bit right now. So
The Teamsters are going to the beach rather than driving across Highway 90 and 80. Let's go to the survey question and get some wider thoughts on this sort of overarching sort of where is this market going into the fourth quarter? What will have the greatest bearing on oil prices in Q4? Fed rate cuts, which are due to restart this week, that sort of the Trump's banging that drum so heavily hard now for 6, 8 months and finally getting his birthday present. Will it be with cherries on top, 50 basis points? Will it be 25? Will it be shock horror 0? But Fed rate cuts are going to have the greatest bearing in Q4. China stimulus, China data, as Jan has been pointing out, and others, general macro weakness in China continues. So the stimulus going to have to come from the Chinese government. Or will it be supply surplus, OPEC plus adding more barrels into a weaker market? Generally, the expectation all year has been that the supply surplus will arrive and finally sort of push downward. It has yet to arrive in any great way, and that mainly seems to be due to the fact that China kept buying to put into inventories that kept that supply surplus at bay. And the dreaded trade war goes on and on. Will that be the greatest bearing on oil prices? Of course, it's all of the above, but that's a big mashed potato. We got to get you to decide on one of these. What will have the greatest bearing on the direction of oil prices in Q4? Take your pick. Jan, welcome your thoughts on that greatest bearing. I was in, as I said, a week ago doing the podcast from Singapore, and it was on the back of S&P Global Commodity Insights APEC conference had just put forward their forecast for the fourth quarter, which is oil prices down $10 on Brent through Q4. Your thoughts on the direction of travel and what will have the biggest bearing on pushing it?
Well, I mean, the short term, I think the market sentiment is bearish, right? I mean, a piece of bullish news will lift the market by 50 cents, 75 cents. A piece of bearish news to drive it down a lot lower than that, right? So sentiment is bearish, right? Fundamentals is underlying. That's bearish too because of the OPEC plus production increases. Nobody expected them to increase in October, and here we are, right? And then demand is not great. China is improving, but not, as I said, what it used to be, right? So, and it will be a long while before it gets back to what it used to be. The other aspect
but
of
the
demand
bearish tone, Jan, just to sort of devil advocate on you, despite the sort of doomsday supply surplus narrative that's been around all year, Brent has held solidly around 65 for the last quarter or more. And despite OPEC Plus doing a fairly significant increase over those 6 months, prices have held despite the bearishness. What's that prop?
So the thing is this, right? I mean, let's talk about OPEC Plus for one, right? They're increasing production, but that also means they're reducing spare capacity, right? And the Middle East is anything but stable, right? I mean, despite everything, I mean, we are in a lull, but the situation can change at the drop of a hat, right? And if
We saw that
so
last
far,
week, obviously.
yeah, so far, oil infrastructure has not been hit, right? But what's stopping it, right? I mean, Israel hit Qatar. None of us expected that, right? And if something were to go, I mean, the likely point or the likely target is Iran. If something hits a major oil supply field in Iran, I think the market can turn bullish very, very quickly, particularly with a lack of spare capacity, right?
So the
On
more
the
you
other hand,
increase supply, inevitably the
yeah,
less idle capacity, and that obviously
yes,
has its own, particularly
right,
in an energy security sensitive
yes,
world.
yes, exactly. I mean, China will continue buying, as we have seen, for energy security purposes, right? But the storage tanks is not endless. They can't buy forever, right? How far along the way are we? I'd say they are not quite there yet, and they could create more capacity if they really want to, because there are so many refineries. Nobody knows for a fact exactly how much capacity they can hold, right?
Well, they can
If you
certainly build
assume,
every day an extra few tanks, no doubt about that.
yep,
Omar,
exactly.
your thoughts just immediately on the what's built into the market for the Fed cut coming this week. If it was to go, I mean, it's built in 25 basis points. If it was to go 50, would the oil markets rally on that, do you think?
Well, I mean, not if they're looking at supply demand, then they'd have to basically sit on their hands and wait for somebody to tell them how they collect the supply and demand and what it's going to be, right? So I think basically that no, nobody's going to sit on their hands. I think if they announce 25% cut, they're going to buy. And if they announced a 0.5% cut, they're going to buy more. I mean, this market is all about liquidity. And it just, I have an opposite view. I think basically liquidity and macro rules markets. I think geopolitics are a risk to the upside. And with all that stuff, nobody that I know is going to basically strategically, with oil, with Brent at $67, as a strategic thing, say, you know what? Even though we've got all these risks and we've got all this liquidity, I'm going to sell oil because it's strategically the right thing to do. I just don't think that's remotely credible. So I think basically we go higher.
Brian, in that sense of where obviously there's been huge pressure, as Omar mentioned earlier, politicization of the Fed. I mean, the Jay Powell now in his final 6 months or whatever it is, and the outlook being that there will be a Fed chairman selected because of their willingness to be bearish in Fed cuts. But where is the underlying health of the economy here? Is there a disconnect of the scale that Omar signals that the sort of real economy now is not the driving force into these decisions?
That's a great question. And what I'd answer it two ways. One is if you look at the equities, if you look at S&P 500, you look at Dow Jones, you look at any of the stock market metrics, the U.S. economy is fantastic. Oh, it's great. It's great. If you talk with real people, and I'm talking not the billionaires, just real people, anywhere from lower to middle to upper class, things are tight. Inflation is hitting. And inflation is hitting a lot because of trade wars, trade policies.
Which is still
And
to trickle through, right? I mean, the full ramifications of the customs duty and all of that onto the supply chain inflation.
Well, you're paying yourself though, because the American companies are paying that burden into the system, which then lines the pockets of, say, larger companies that are increasing their equity position on the S&P 500 and the Dow Jones. But then when you look at a middle class or even upper class citizen, well, I didn't get a pay raise this past year. Yeah, I mean, I run my own company, so I'm not included in that class. But you know, the real people that I talk to, that I communicate with, the oil and gas independent producers, they've had an incredibly tough three 5 years. They've been reeling since COVID, just trying to keep the doors going, and it's part of the reason the big companies have been accumulating. So I would say if you look at just the stock market metrics, you're going to get one picture. But if you look at the underlying is that
And they say in
there's
the
a
stock market itself, it's 10 companies that is basically lifting all indexes. The tech is the one there.
precisely. Yep.
Jan, quick wrap up with you just to get a wider view across Asia. China, malaise is clear, and we've got that anchored and repeated. But where does the rest of Asia is going in this sort of demand outlook? Weak dollar, strong national currencies, that must help. Lower
Well,
interest rates.
yeah. Well, of course. I mean, the bright spark is actually India, right? The Indian economy has been strong. We are looking at above 5% growth last year. This year, we're expecting something like 6, 7, 8%, right? And India's demand has been steadily increasing, right? I mean, if you look at all of Asia as a whole, broadly, we are talking about 100 million tons a month, of which China accounts for about 50%. India is about sort of 15, 20% of that, right? However, the 50% on tariffs on India and now being threatened on China as well because of importing Russian crudes may change that picture. But as of now, the Indians have stuck to their guns and say, right, we'll continue to buy Russian and we'll find alternatives, right? But the rest of Asia has not been fantastic. The other major economies, Korea, Japan, has been fiddling along, right? Again, the demand from an oil perspective for Korea year on year is higher, but we are not at pre-COVID type of demand, right? Korea, in any case, is an exporter, right? They export a lot of diesel, and if the rest of Asia is not great, then where are those exports going to go, right? Yeah, and the thing is this, right? At the end of the day, Europe is the major importer of diesel. So all of this points there, right? But there will be a shift coming because the EU has said that they will not buy diesel from India if they continue to refine it with Russian crude, right? As of today, India accounts for about 10 to 15% of the total diesel imports into Europe, right? The major supplier, of course, is the Middle East, right? The Middle East could probably fill a large part of that vacuum. The rest of it will probably have to come from East Asia, but it's going to be expensive, right? Freight is a lot longer. You still have to go around the Cape. You can't take the Red Sea. So how much?
Good for diesel demand, good for fuel oil demand. We got to wrap it up there. Brent crude oil trading. What do we got? Supply surplus is the two out of three vote here. Trade war getting some attention. Fed rate cuts seem to be down the back of the room, and nobody's paying attention to China stimulus. The sort of boy who cried wolf a little bit too often on China stimulus. Omar Najia, BB Energy, thank you so much. Brian Pieri in Colorado and Yang Chong Yao, you Wood Mackenzie in Singapore, really appreciate your time today. Let's see if this market can get any real direction this week rather than piddle and paddle between 65 and 67 on Brent. Will the Fed not only announce, but with its press conference afterwards, signal that indeed they are going into a much more radical cut cycle? They're finally delivering Trump all his Christmases at once. Will they deliver that in the press conference afterwards? These are all the signals that we'll be watching. But let's get back to work and see where the day takes us. All the best, everybody. Have a good week.
All right.
Thank you.
Cheers. Bye bye.
Thank you.
Thank you.
Thank you.